This is News You Can Use.
Doug, tell us what they did yesterday that was notable, like one or two words they changed or they didn't raise rates. What happened yesterday that was newsworthy with regard to the press conference in the aftermath and anything that the Fed released by policy?
Sure. There was no surprise that they did not increase the federal funds target rate. They had signaled that to the market that they were not going to do that. So what the market was listening for was, what about the future? Do they still expect to raise rates additionally in the future? When do they expect that to be done? When would they start cutting rates? So they substantially increased their expectation for growth in 2023. They basically doubled it from 1% growth to 2.1% growth in the summary of economic projections, which they put out quarterly. It's the opinion of the 19 people that are involved. It does not lock them into a policy position. It just gives the market information on what they're thinking. They also changed the perspective on where rates would go next year. Previously, there had been an expectation of 4 rate cuts in 2024. That was reduced in their summary of economic projections to 2 rate cuts. That's consistent with the thing that I have talked with Pat and his clients about before, which is Powell needs to be taken at his word that the Fed will be higher for longer. Reducing those 4 cuts to 2 suggests that's exactly what they expect to do, is hold rates higher for longer. So what you saw was a response in the market and rates rose. That's a reasonable market response to that. But I would say it's very sensitive whether the Fed, which 12 of the 19 participants suggested another quarter point increase in the fourth quarter. 7 suggested no change. It's going to be very sensitive to what they see happening at the consumer level in the fourth quarter. The surprise to them was that, and to us, was that consumer spending was significantly stronger than they or we expected. If that shows a weakness going into the fourth quarter, that will reduce the likelihood that they will raise again, and the market will argue for more cuts. That part, I don't believe the Fed is going to satisfy them with, unless we get a recession, which we actually have in our forecast for the first part of next year. The bulk of the market does not have that in there. We're sort of contrary on that. But it's mild, and it's mild in our view because of housing, which is going to be a key support if there is a recession. It's also a key support if there is a soft landing. When he talked about the reasons that the Fed's forecast was increased, the only 2 things he cited were the strength of consumer spending, and he gave a nod to the housing construction space. That was a significant comment from my perspective.
So the Fed, of course, is a policy setter for short-term interest rates. For all intents and purposes, 30-day rates. So they are related to 30-year fixed rates only to the extent that they tell a tale to the bond trading community about what's going on in the overall economy.